I'm Allie Canal in for Brian Sazi, and you're taking a live shot of the opening bells on Wall Street this Friday morning. Pearson ringing the bell at the NYSE, celebrating the 25th anniversary of its listing, and Global Citizen getting things popping over at the NASDAQ. This as traders digest PCE data, the final full trading week of the month and the third quarter, plus new tariffs on everything from pharmaceuticals to furniture. Now, opening bid is all about serving up the investing analysis you need to know to unleash the power of your portfolio. We're digging into what's really moving stocks, giving you the unbeatable context to make the best decisions with your money. And let's get a quick check on the major averages as we kick off trading and send it down to our own Brooke DePalma, live from the NASDAQ in Times Square. What are you seeing this Friday, Brooke?
Good morning, Allie. What we saw heading into this week was record highs, and then in the middle of the week, we saw 3 consecutive days of losses. And now moving into this week, in pre-market trading, we did see all 3 major indices pointed to open in the green. Now we are seeing some downward pressure coming from the NASDAQ. The Dow up about 0.4%. If you take a look at the YF Interactive, up over the past 2 days, roughly flat. The NASDAQ now flat at the open, and we also have the S&P 500 up about 0.2%. Now, once again, I want to take a closer look at the S&P 500 because over the past month, what is typically a very weaker or volatile month, now we're seeing the S&P 500 up more than 2% so far this month, and it is expected to close higher to end this last week of trading into next week, which will ultimately end Q3 as well. I do want to take a look, though, at one of our top trending tickers on Yahoo Finance, and that is Costco. Costco, of course, a bellwether to describe really the consumer and how exactly they're seeking value. And now at the open, we are seeing the stock trend lower, down nearly 4% at the open. But heading into this report, there was some optimism for the company to really, beat Wall Street's expectations, which it did. There was some optimism for it to yet again stand out as a key contributor for consumers as they seek out value and bulk in this sort of environment. But year to date, Costco has really struggled to impress investors. And perhaps we're seeing this really downward momentum today, down nearly 4% after we did get a price target cut to $1,050 from JP Morgan this morning. That was down from a previous price target of $1,160. That $1,050 would only imply an 11% upside over the next 12 months. Right now, the stock's sitting around 908, and year to date is down more than 1%, and that's far different than what we've seen from other retailers, especially Walmart, which has been up over 10%. I also do want to take a look quickly at crude oil. We are seeing crude oil this morning modestly higher, up about 0.4%, and that's largely after we did hear from OPEC Plus that they're agreeing to revive production in the month of November. They're going to increase production there, and this comes as we have seen crude oil really take a dip year to date, down nearly 11%. But once again, taking a step back, all 3 major indices, a bit of a upside here. We're up now for Dow, NASDAQ, and the S&P 500, all seeing just very modest, slight gains at the open.
Yeah, Brooke, it's been an interesting week. A bit of a pullback compared to the records that we've been used to, but still a strong September. Thanks so much. Well, we're kicking things off with your daily guide to the biggest market drivers of the trading day. Here's what we're watching. Number 1, the Fed's preferred inflation gauge coming in line with estimates. PCE inflation picking up just a bit in August, rising 2.7% year over year compared to 2.6% in July. Still, the slight move leaving the door open for another rate cut in October. Number 2, stocks are bucking September seasonality trends. The S&P 500 poised to end the month higher by over 2%. Meanwhile, Wall Street is warning that stocks are expensive, but that could just be the new normal. And number 3, the tariff war isn't over just yet. October 1st, a slew of new tariffs will take effect, including a 100% tariff on some imported drugs, 50% on kitchen cabinets, 30% on upholstered furniture, and 25% on big trucks. On top of that, the Wall Street Journal reporting that President Trump plans to mandate a 1-to-1 policy for chip makers to manufacture as many chips in the U.S. as they do overseas or face hefty tariffs. Here to break it all down, Sam Stovall, CFRA Research Chief Investment Strategist, and Yahoo Finance Senior Reporters Brooke DePalma and Inez Ferre. So Sam, I want to start with you with all the trade headlines that we've been seeing over the past 24 hours. Is the trade war back?
Oh, sure, Allie. It seems like it is back, and with brand new areas to focus on. I think that one of the biggest is with the home furnishing area. So companies like Restoration Hardware, like Wayfair, like Williams-Sonoma, certainly feeling the pressure right now. And questions are, how will things eventually shake out?
And I'm curious, with that potential chip plan down the line from President Trump, on top of the rest of the tariffs that you were just mentioning, is the AI-driven hype enough to offset some of the vulnerabilities that we could see in markets?
Well, I think the AI hype is real. People always talk about equating it to a baseball game. Which inning is it in? Our belief is we're probably still in batting practice. So there is tremendous growth expected for AI, as well as the periphery industries that support AI. And when you're dealing with growth expectations of more than 20% for 2026 for technology versus about 13% for the S&P 500, investors likely are still going to focus on these growth areas.
Yeah, batting practice. And we know a baseball game is 9 innings long, so a lot of runway potentially here. Go Phillies, by the way. Now, Brooke, based on what Sam was just talking about, September has been really strong. We've been able to buck a lot of those seasonality trends. What's Wall Street saying about the ability to maybe reach higher highs through the end of the year?
Yeah, we've heard lots of commentary from the street about how exactly far this run can go, including earlier this week, Goldman Sachs raising their year-end target for the S&P 500. Also, Wells Fargo, as well as other firms, really raising that year-end target of what the S&P 500 could reach over the next 12 months. And really, what we've heard, what it really all comes down to, and Citi equity analysts pointing this out in a recent note, that the key to market health from here is whether long-run earnings per share can deliver on the embedded expectations that they have. They said in a note that that's what makes this different than the late 1990s, the early 2000s, as we've seen this momentum, these strong reactions within the market to these companies, especially those tech and data and AI companies, beating expectations and the return that they're seeing from investors. It's also worth noting Ryan Dietrich from Carson Group over there, the chief market strategist, saying that typically when May, June, August, and September, as well as July, or happen to be strong when it comes to the S&P 500, they have never seen November dip lower. But he did go on to say that October and December do tend to be down on average when it comes to return. So something to keep in mind, especially as we head into that new month next week. But what we've seen over this past few months is really this strong momentum continuing into what you have said, a very volatile, weaker month. And we've seen record highs up until this week. And it'll be interesting to see ultimately what this comes down to today. If this will be the first week of losses and the only week of losses in September, or we continue to hold on to that momentum that we've seen, especially over the summer.
So Sam, are we entering a phase where lofty valuations, they're just the new normal and stocks are going to continue to be expensive?
Well, that's a possibility, because when I look back over the past 20 years, I see that the S&P 500 is trading at about a 40% premium to that long-term average on forward estimates. If I look at a 10-year average, then that premium is cut in half to about 20%. But on a 5-year basis, because that's really when AI started to dominate the market cap, the earnings growth, the price momentum of the S&P 500, you could say that we're dealing with a high single-digit premium. So yes, possibly we are due for some sort of digestion of gains. But as Brooke had mentioned, the fourth quarter tends to be pretty strong. And even if we have a positive August and September, going back to World War II, the fourth quarter returns have been unchanged, still more than 4% with an 80% frequency of advance.
And Inez, on a sector basis, healthcare has been a big laggard year to date. What's the street's read on the viability of that trade, especially considering the new pharma tariffs at play, although there are significant carve-outs too?
Right, and one of the big carve-outs is the exemption that if a pharmaceutical has a manufacturing plant that it has started by October 1st, then it's exempt from those tariffs. But look, most U.S. pharmaceuticals already have manufacturing plants in the U.S., and that's why you have Wall Street that is basically saying that this is a sort of a muted reaction, what we're seeing in the pharmaceutical space with these new tariffs, because you have Mitsubishi saying that the impact is going to be negligible, perhaps. You do have some best-selling drugs that are still made abroad, like, for example, Ozempic, but Novo Nordisk, the manufacturer of it, already has a plant that it is starting in North Carolina. Some of the biotech firms, smaller biotech firms, those may be more exposed, but also there's still unclarity, or it's unclear how the, for example, EU framework that caps the pharmaceuticals tariffs but to 15%, how that deal with the U.S. would sort of align with what these new tariffs that are that have been announced. But look, as far as XLV is concerned, you're looking at today at a muted reaction, and overall this year, XLV has been the underperformer. If you take a look at a one-year chart of it, it's down on a one-year chart basis. And if you take a look at a two-year chart for healthcare, it has grossly underperformed. It's up 2% over the last 2 years, where you've got technology and communication services that are up more than 66% over that time frame. So you are seeing that healthcare has been a major laggard for one reason or another, whether it be that the targets on the prices, that the Trump administration wants drug prices to be lower, or whether it be the backlash on vaccines. For one reason or another, they have not been able to perform the way they did during the pandemic, and you're seeing that healthcare has been a laggard this whole time.
Sam, what are your thoughts on healthcare? Is now maybe a time to get in, or are there other sectors that you're more bullish on?
Well, I think that healthcare is in the doldrums, and there's probably an awful lot of overhead resistance from a technical perspective to really expect them to outperform. We have an underweight recommendation on the healthcare sector simply because of all of the pressures coming from Washington. If you are looking for an area that has potential for starting to move higher, I would look to something that has two factors to it. One, small cap, and two, energy. So the Invesco S&P Small Cap 600 Energy Sector ETF, PSCE, our Lowry Technical Analysis Group, is showing that this is an improving group both on an absolute price and what their proprietary power ratings perspective.
And finally, one thing that could impact all of these sectors is the Fed. And we just got the latest read on PCE inflation, coming in mostly in line with expectations, a slight uptick month over month. Sam, does this change the calculus at all for the Fed when it comes to future rate cuts? Or do you think the markets maybe have gone a bit ahead of what the Fed really wants to do here?
Well, I think for investors today, they're breathing a sigh of relief that these PCE numbers were actually slightly cooler than anticipated, because let's face it, we just had initial claims report and the final Q2 GDP come in hotter than expected. So the worry was, maybe we're only going to have two cuts in this final quarter, meaning September and December, rather than the three that's already baked in. So I would say that the cooler than expected PCE has put the October and December cut back on the table.
All right. A big thanks to my panel today, Sam, Inez, Brooke. Appreciate it.
My pleasure.
Well, coming up for today's Power Player segment, we have the CEO of Better.com to talk retail investor momentum, rate cuts, and more. Don't go anywhere. Shares of Better.com are up nearly 75% in the last week as retail investors pile into the AI-powered mortgage lender. The momentum coming after hedge fund manager Eric Jackson, the man behind Opendoor's recent rise, announced a long position in Better, calling it the, quote, Shopify of mortgages. Joining me now for today's Power Player segment, Better.com CEO Vishal Garg. So Vishal, let's start there. Huge upswing in your stock price. Some are calling it a meme stock. What's your reaction to that label?
I don't think it's a meme stock. I think we have over 100% revenue growth. We've indicated that we're on a path to profitability by third quarter 2026, so just within the next 12 months. And we have the world's largest asset class that we're revolutionizing with AI, U.S. residential real estate, $15 trillion market, and filled with inefficiencies that are basically like, 60 days to close a mortgage, $10,000 to get a loan, 28 people involved. And we're able to make that nearly instant with AI. And so I think we do believe that we can be the Shopify of mortgage through our platform, Tin Man. And we think the growth prospects of the company are extraordinary in the next couple of years.
And you now have this surge in retail attention in trading volume. How do you plan to maybe leverage this moment, leverage this share price? Are there any conversations about reinvesting back into the business or maybe strategic acquisitions or something else?
I think the biggest thing that we've been doing is I think it re-energizes the company. The company was the fastest growing fintech in America from 2016 to 2021. We built a business that went from 500 million a year of volume to 58 billion a year of volume, over 100x in that 5-year period. But it was relying at that time on refinances through better.com. We've now, leveraging the advances in AI, reconfigured the platform so that we don't just serve better.com, but we serve hundreds of mortgage brokers around the country who are building their business on top of us. And we're increasingly becoming the platform of choice for fintechs and other big mortgage companies to build their customer relationships on top of our AI underwriting and processing platform, which also enables them to take advantage of the investor network that we've built, which at its core is a matching engine between consumer credit, consumer properties, and 45 institutional investors that comprise over $1 trillion of annual demand in the mortgage market.
Now, Eric Jackson's targets are pretty eye-popping. He said the company can deliver $12 billion in revenue and a $12,000 share price by 2028. Do you see that as realistic? And what would need to happen both internally and macroeconomically in order to even approach that level of growth?
I think the thing that would need to happen is you'd need to have interest rates likely come back down to levels that we saw, not necessarily during the pandemic, but even levels that we saw in the period from 2015 to 2019. I think that would dramatically increase affordability and reduce friction. So many Americans today are stuck in the homes that they either bought during the pandemic or the ones they've had before. And there's a huge migration pattern taking place in this country from the Northeast, from California to the South, the Southwest. And we think millions and millions of home transactions are going to take place. And for us to achieve, that level of revenue would require us to achieve something in the order of about 10% market share in a reinvigorated housing market, which, if you believe that we have the lowest price, which we validate through the better rate guarantee, the fastest closing times, which we share on our website, are about 14 days faster than the industry average, and the fastest approval process, where we'll give you a commitment letter the same day you go into contract on a house. We think that we can get to 10% market share in a housing market that's more stable and normalized with interest rates.
So you just mentioned interest rates, and we do have a Fed that is easing. However, we've heard from some experts that doesn't automatically guarantee mortgage rates will continue to tick lower. So how sensitive is your business to the interest rate moves? And is a Fed cut through the end of the year, multiple 25 basis points, is that really enough to move the needle for your business?
Oh, totally. I think the number of consumers in the money, if the Fed cuts another 3 times, almost doubles. In the consumers in the money for a refinance. And last time in 2021, our peak market share was about 2.5%. So if you think about the 10 million plus consumers that can now benefit from a refinance or a cash out refinance, we're talking a decent number of loans. We're talking about 250,000 mortgages. 250,000 mortgages is almost $1.5 billion plus of revenue that goes to the company, and is a substantially higher level of revenue than what we're doing today. So we think that just a few rate cuts does make a difference, but more importantly, our home equity business is on a tear. We are the fastest growing home equity lender in the country. We're at $1 billion origination run rate. The largest non-bank home equity lender, Figure, is at $1.5 billion run rate in its direct-to-consumer business. So we're about 2/3 their size, and yet our market cap is 1/7 of their size. So I think there's just a ton of room to grow. Home equity used to be $1 trillion business in the US before the global financial crisis, and the home equity line of credit just went away. And in its place came auto loans, student loans, personal installment loans. And all of those products are inferior to a home equity line of credit in that they're much more expensive, for consumers that are homeowners. And all of those products can be consolidated with a home equity line of credit. Our consumers that are taking out a home equity line of credit from Better today are saving $1,100 a month when they're consolidating their debts. That's money that's going back into people's pockets right when they're, income insecure and inflation insecure. So we think there's just a lot of runway going ahead.
Now, in your latest earnings, you posted $1.2 billion in funded loan volume. That was up 25% year over year, revenue climbing 40%. Still, the company does remain unprofitable. You do have confidence that you'll reach break even by late 2026. So what's driving that confidence? Is it AI? Is it the expectation of continued Fed easing?
I think the biggest thing is the AI, right? We disclosed in our financials that we've dramatically improved the conversion rate by about 35% of all the traffic that comes into us, leveraging Betsy, our the industry's first voice AI loan officer. We've dramatically increased the customer experience, our response times, and we've been able to use the AI underwriter and AI processors that we've developed to dramatically increase the productivity of our staff by almost 10x. And that just means more loans per employee, which means more revenue per employee, and that helps us scale while keeping our fixed cost base basically the same. And I think as we scale, and we've already said that we'll double revenue again in the coming year, a lot of that revenue growth will go back down into the bottom line and get us to that path to profitability.
And finally, Vishal, as you look to shed this meme label and really prove out your model, what's your message to investors when it comes to separating the hype from the fundamentals?
I think read the earnings transcripts. I think read the financials. I think, define which company is an AI native company. Go to better.com and apply for a mortgage and see if it's not the best mortgage experience of your life. And if it isn't, email me at vg@better.com. I think those are the things. That's why I'm confident that we're going to be not a meme stock, but a, household name growth stock.
All right, better.com CEO Vishal Garg, thank you so much for your time today. I appreciate it.
Thank you.
Well, coming up, Yahoo Finance's Market Catalyst. We bring you the news behind the market moves for the trading day. You won't want to miss it.